All right, now, according to the Financial Trust Index, Americans are slowly improving their view of the nation's banking system. The index is co-authored by Luigi Zingales, professor of finance at the University of Chicago's Booth School of Business, and he joins us to discuss the index on the same day Bank of America and its former CEO, Ken Lewis, were charged with fraud. So, Luigi, thanks for joining us. I wonder if Andrew Cuomo takes part in your survey here, because he doesn't seem to be very trusting, at least of Bank of America.
No, I think that Andrew Cuomo is probably takes his own survey. He understands that Americans do mistrust banks, and he's trying to capitalize on this mistrust.
A political move, then, you're saying?
Absolutely.
Well, it's kind of interesting, though, Luigi, because Matt and I were working through your latest financial trust index. I mean, what you find, and you measure a lot of things. You look at the bank recovery, at the stock market, you look at housing, you look at a lot of things. I mean, things have improved. People have more trust in the system, and that's what you're finding.
Oh, absolutely. I think that overall, especially sort of people are more confident of the stock market. They see the probability of a large drop going down in spite of the rally that the market experienced in the last year. We see that people are less afraid of a severe drop. They're less afraid of a severe drop in house prices in the next 5 years. They do trust value institutions more. The harder one are still banks. I think there is still a lot of mistrust in banks, in particular national banks. If you break down by sort of credit union, local banks, and national banks, I think that they trust the credit union almost twice as much as they trust the national bank. So there is a huge gap. National banks are not perceived to act in the interest of their depositors.
Why is that? I mean, are the big banks have a bad rep because of the prop trading, because of the private equity and hedge fund activities that Paul Volcker is railing against these days?
I don't know whether that's the reason. I think that actually most people probably are not aware of the causes of this, but they are aware of the fact that at some point they had to worry whether their deposits were safe. And they hear constantly that these banks are either accused of fraud or accused of sort of taking excessive bonuses, etc., and they're still quite resentful. What is interesting is also the demand for intervention in the economy in general has subsided, but not in the banking sector. I think that people are still want sort of the government to intervene in the banking sector, and they want the government to intervene in the housing sector.
But help me out, because from your financial trust index, didn't you find that also demand for regulation and government intervention has started to subside, so that people are saying we don't need it as much?
Yeah, I think that people are reconciling themselves with Main Street. There was like a very scary statistic a year ago in December '08. The majority of Americans wanted the government to intervene more in the way companies were run. I thought that was really sort of a scary picture. I think that number has gone down a lot. So, and even the demand for capping executive compensation in general has decreased over the last year, which I'm surprised by. But the demand for some intervention in the financial sector, no, that remains high. And I think people's mistrust our banks remain high.
But what do you think then about the president's move to demand that the Volcker Rule be included in financial regulatory reform? I mean, it doesn't seem to sit so well with Chris Dodd, even, a Democrat there. I mean, what do you think about Mr. Volcker's testimony, Chairman Volcker's testimony in front of Congress this week?
I think that from the point of view of the president, is a very sort of populistic move. I think that will this rule help a bit making Wall Street less risky? I think so. I don't know how difficult it is to implement, but I think it will implement, but not really change dramatically things. In this crisis was not created by proprietary trading of commercial banks with deposits. This crisis was mostly created by investment banks that had no deposits, but took an enormous amount of risk, not necessarily in trading, but also sort of in their balance sheet, and spread the risk throughout the system. So I think intervening, like Volcker is suggesting, is putting a Band-Aid to a much more serious problem.
All right, good to get your input, Luigi. We appreciate it. Professor Luigi Zingales, professor of finance at the University of Chicago Booth School of Business.